Welcome back to Primary Source China Investment. We are here with show V, and we're going to get into it this week with two topics related to what's happening in the news and the marketplace. We're going to kick it off with yet another way to look at China stocks. So navigating the policy and the markets from 8,000 miles away is a failed strategy. And as a review, we've already talked about the numerous ways you can invest in quote unquote China. So the first way was A shares. These are Chinese companies listed on the mainland, Shanghai and Shenzhen. And in the US, there's a number of ETFs, but the largest ETF following that is ASHR. That's the CSI 300, the major market index. The second way is to follow those Chinese companies that have been listed here in the US. And a lot of those are high-flying tech companies, but there's 250 of them with a market cap of about 2 trillion. Now, Gensler at the SEC just put a moratorium on new issues, so it'll be interesting to see what happens to these 250 companies. We've also highlighted the H shares, which are Chinese companies listed in Hong Kong, and that is traded under ETF called EWH. So this week, we're talking about the fourth way. And that fourth way got us thinking about US companies that derive a lot of their sales from mainland China. And I mean a lot of sales, more than 50%. So when people think of China, they like to think of Starbucks or they like to think of Nike. But in reality, only 15% of global stores for Starbucks are in China, and Nike sales are a little bit less than 20% in China. So these don't meet the threshold. But there are companies that are predominantly selling their products in China. And we're going to put up a chart and follow this small portfolio. There's only 10 names, and I have prices in as of Wednesday when this dream came up, Wednesday the 28th. So some of the names include Qualcomm, Qorvo, Texas Instruments, Broadcom, and Win. Now, Win is a little funky. The majority of their profits come from Macau, so we can quibble. But this is generally the idea, and we're going to track that against the ASHR, the CSI 300, and we're going to track that against PGJ, which is the ETF that tracks a lot of these tech companies, and EWH, which is the Hong Kong which is the US listed ETF for Hong Kong.
I think the fourth way might be definitely a good idea. So is because China has been the engine of the world economy for a long time, it will give the much benefit for the stock price for the individual company. I just see a news yesterday. It says like the US company in China, only 10% get loss. 90% of them still get some profit. It looks like most companies still want to run business in China rather than shut down. Yeah. So it looks like they're still profitable. And also in my daily life, you can see it's every industry always like the US name. From the industry chain, the upstream is still by the US companies. And I think it's for this way, you really want to make the industry analysis. So I remember I used to work on some upstream and the downstream index. So for the bigger industry, if you split with the upstream and the downstream, and then you will figure out to get the major revenues from the China. So that is also a good way to do analysis.
These companies in general are navigating the policy and the rules and laws of doing business in China probably better than these Chinese companies are navigating the listing requirements and the disclosure requirements here in the US. And this is a rare agreement between the Chinese Communist Party, the Democrats and Republicans. It does look like nobody wants Chinese companies to list in the US any longer. So this is a huge policy shift. You know, a couple of shows ago, we said DD changed the playing field. And I stand by that. I do think that DD was a watershed event. And we're going to monitor what happens with these 250 companies. Are they going to delist in the US and relist back in Hong Kong or on the mainland?
DD really a bit awkward. From the US perspective, it's a Chinese company.
Yeah.
From China perspective, it's really the majority the U.S. people own it and or make the decisions for this company from the shareholders perspective.
Yeah.
So is that a really Chinese company or U.S. company? I think maybe this assumption is wrong. So it's,
Yeah.
it's just a company running business in China.
Well, this is also part of that VIE structure we talked about. And also, it's interesting that technology, education, and I guess rideshare, delivery, a lot of these industries that are discouraged from foreign investment are the ones that are being looked at more closely by the Chinese government. And I suspect that companies that list in the US that are in those industries are going to have more and more scrutiny, because the policy is foreigners cannot invest in those industries. And through this funky VIE structure and going public in the US, they're having foreign investors in these industries that are either banned or discouraged from foreign investment. So there is some logic behind the headlines.
That's true. VIE is a popular structure used for multiple years, and everybody knows that in the market. So obviously, China also have their regulations about the industry. But I think right now it's people realize the risk. I think that, yeah, they should figure out how to do it in the next step.
Yeah, so we're going to put this portfolio up there. We're going to be tracking it. Maybe there's some long-short strategy. Maybe we can talk about it with our listeners. So we're going to leave it there for markets this week, and we're going to shift into policy. So usually investment follows policy, but today we're going to do policy following investment, because in the previous section, we talked a little bit about this VIE structure and some of the legality about going public in the US for on-the-ground companies in China. So one of the things that peng.guo mentioned a number of shows ago was that the experience level of a lot of these politicians in China is pretty low vis-a-vis foreign policy. Because China is still very top-down, you have a lot of these politicians who have a lot of experience in China, but they don't have a lot of experience outside of China. So right now, what we're dealing with in terms of these equities that are listing in the US or that have listed in the US is a combination of policy that was ambiguous at best with the reality of investors going into industries that are either banned or discouraged. So we have a little bit of policy by the seat of your pants. And for all the talk about China is a long-term thinker, and they have 5-year and 50-year plan, 100-year plans. Those plans are great until things change so rapidly. So this is the externalities that happen. And right now, like we talked about just a few minutes ago, there is some logic about implementing these rules for companies listing in the US. It's not that the Chinese government is going after education companies, but education is an industry that in China, foreigners are discouraged from investing. You have to have a joint venture established. A lot of people talk about Duke University in Quinsan. Yeah, Duke University in Quinsan is a joint venture. So all of the classes, all of the instruction has to be approved. This is not a random act to go after education companies or a random act to go after technology companies, because technology is very sensitive. So is broadcasting, so is media, so is oil exploration, so are financial services. All of these industries are heavily regulated in China.
Yeah, I think we still need to see the big picture. So I think a big picture first is the history, and secondly from the country level. Most policy, especially important policy, is not just a joke. It's really think about it for a very long time and try to solve the social problem. I think that could be the assumption for most of the policies. So if like sectors, some of the change or the innovation hurt the entire society's benefits or the disadvantage is outweigh the advantages. So that might cause the government take some actions to do it.
Yeah, but let's
So
not be naive. It's also about control. I mean, education is, even here in the U.S., the government educates people. We have local governments educating people, but government educates people.
Yeah,
you're free not to attend school, I guess. Maybe I don't know what the laws are, but
yeah, that's right. So I think this is really the industry leader. They should be able to think about from the country perspective rather than just the sector perspective, because they always have some of the conflict between sector as well as society.
Yeah, I look at these industries and I map them against the industries that are, for lack of a better word, protected in China. And there's a huge overlap right now. I don't see the apparel industry under threat in China. But more importantly, those companies that are doing businesses in industries that are wide open have no such problem. And that goes back to the investment thesis that we talked about. These 10 companies are doing businesses that are free for foreigners to invest. And they're selling their products in China, and they're navigating the policy quite well, actually.
That's still, if that is the case, that's probably like a company levels risk, specific risk. So, it's so complicated. I think each sector and the society is really like the ecosystem. So sometimes the government make the not consider the entire ecosystem. They just usually just do the simple policy and cut everything down. So that's always happens in China multiple times.
That's a heavy-handed regulators.
That's right. So in that case, is probably I think like in China, the portfolio manager or the investment professional, most of the time they were started with the government, like the 5 years plan or on this year's like the theme on the market, and then they try to follow the same and find the investment opportunities. So
this move against technology education, this is an exogenous event, right? Because it was not telegraphed well. It was not. If it were telegraphed well, people would have sold out a priori, but they didn't. So this absolutely caught people off guard. Going forward, I don't think it's going to catch that many people off guard, because now people see, okay, what's the next space that the government may say, hey, look, we need to put a moratorium, because those are real risks. And I'm sure there are people that are looking at healthcare industry. That's a perfect example of where there are risks for the government to step in and say, hey, wait a minute, you're collecting data, you're disseminating data, you have personal information on people. So that, to me, is a very risky industry for Chinese companies that want to list that are already listed in the US in the healthcare industry.
I think that's probably in China. They normally split to the private company and the state-owned the company. So then some of and also the regulation involved there. And some of the regulation implementation still rely on the people. So even like the COVID-19 period, like the Nanjing airport, they have the new guy in charge the airport. They screw up the whole thing. They spread the Delta variant to almost the entire country.
Absolutely. Well, there's no doubt that policy is still top down. Understanding policy is key to successful investment thesis. We talk a lot about different asset classes on this show. This week was on the equity side. We'll probably revisit the commodity section in the coming weeks, because there was a huge run up in the commodity space. There's been some sell off, but now there's clearly been a bifurcation of different commodities. So we'll revisit that in the coming weeks, and hope you tune in to Primary Source China Investment. Thanks.
Thank you.